Okay, we'll get started. So, first off, apologies for postponing the Friday session. I did have to spend most of the day with my mum. She is needing more and more help these days, and I've got two sisters that help out, but I live closest to my mum by a long way, so I'm always on call. Last week, from a trading perspective, was very dry for me because I did spend a lot of time helping my mum, and it's somewhat ironic that when I was talking about this being a 24-hour job for me, someone said, "Do you not have a family?" And I said, "Oh, I do, but they're used to me being in the zone, doing my thing." And then last week, family commitments really took over and got in the way of my trading. I missed a few trades, one in Bund that we'll talk about in a minute, and I ended up taking one trade in the entire week that set up a few hours before the close on Friday, which we'll get into shortly. For those that saw I didn't place a trade on Thursday, you might think, does this happen? That sometimes you get days without a trade? It definitely happens. It's not that frequent. If someone's hearing me say that I took one trade last week and thinking, is that normal? No, it's definitely not. If you've done your analysis and you've got no distractions and you're trading the same markets in more or less the same way as me, you should be finding on average at least a trade every single day, and sometimes two or three in the Bund if you're trading on the short term. But before we get into the charts, let me just quickly cover the issue of the live day recordings. When I said that I make judicious cuts when editing, I got asked the question of whether it was possible to just post the session as it was for the viewer that attended, so they can watch all 5.5 hours and see what it was like. I don't upload the live day without cuts because I want the viewer, most of whom just watch the recordings and don't attend the live day, to have the absolute best learning experience. So I rewatch the entire event when it's finished, and I just cut things like the frequent long silences which occur when I'm analysing and processing market information from my other screens, and I also tend to cut off-topic discussions. My priority for those that want to have the best learning experience and will watch these webinars in years to come is to condense the event so that it's as short as can be without missing anything that's important for you to learn from and implement in your own trading. Essentially, I'm coming at it from the angle of time is money, your time is important, and you don't want to watch a 5.5 hour session if you can get the same information in 3 hours. Watching 5.5 hours, which is how long the live day is, with long periods of silence, breaks, off-topic discussion, it just ends up reducing attention span and making the actual learning process harder to follow. I did consider the idea of uploading two versions, an uncut and a cut version, but the issue I have is that people will just naturally gravitate towards the uncut version, thinking they're missing something. It's like a film. You always want to see the uncut version, or you feel like you're being censored. But trust me, I'm posting the fucking director's cut, limited edition. You don't need to hear me say, "Hi, I'm just taking a break now to make a coffee," and then sit through 10 minutes of silence until I get back to my desk. You don't need to hear me go off on tangents about my hobbies finding missing people, when someone asks me about it and it's a quiet moment. And there's only so many times I can say in the same session, the code for Bund is FGBL. If I say it once, every other time it just gets edited out. So when you're watching, you might notice the candles look a little bit jerky at points because a few seconds has been cut here and there, but it's a small price to pay. So rest assured, you're not missing anything at all via the recording. You're actually gaining something. You're getting a polished version that is far easier to digest. I cut out a lot of ums, which can spoil the flow. And if I flip to the Bund and spend 2 minutes saying, "As I said before, we're still waiting," with literally no new information imparted, then that's getting cut out too. And that is all I have to say on that. So let's start out by covering some of the price action from last week, particularly in relation to what we've discussed in previous sessions, so you can actually see what happened. Now, again, everything I'm going to refer to tonight is something that we've covered during the week, other than the trade I took, which we didn't cover, and I'll mention that at the end. So if you remember, early on in the week, I discussed the level above market in Bund, and it finally actually traded into it on Friday. And that right there is a lesson in how you can anticipate where the market will react well ahead of time. Now, we had rollover in Bund last week, but I discussed in the Thursday live session how you can pull up a continuous chart. FGBL1 exclamation mark is the continuous futures chart, and you can just back adjust it for rollover. That way the structure remains the same even though the price points change. So the level I want you to focus on is this one that I drew right here, and I said I would anticipate with very high probability that there will be a reaction to this. I know that's the exact words I used because I was doing the editing today. And this was basically based on this spike base, which I explained was past ATR, so it was past the average true range, and that increased the chance of mean reversion, and it was above these highs that you can see on the 60-minute chart, where traders would likely get caught puking shorts and initiating longs. To those that are asking for me to show setups, this is a very typical setup for me. So NFP came out on Friday, we rallied right up into that level, and we turned one tick ahead of it. The level I had drawn was at 82s, and the high was at 81s, and that was the high of day. But there's no prizes for being close, right? In the real world, where we're doing this for a living, it still means no fill. No fill means no trade means no money. No money means no honey. Okay, I'll stop there. There is actually an Easter egg of sorts hidden in the live day recording, and I'd like you to go back and watch it, but not everyone will, so I've taken the liberty of screenshotting my own recording to show you something that you'll be able to go back and watch, and you'll see, aha, that's interesting. So let me bring this onto the screen. Now, I cover my plan for the day ahead, and I specifically write down the levels that I'm looking to trade. And you will see here that I've written down that the level below market is 33.67, back adjusted to 33.16. And when you look at the chart in the background, the level down there is at 33.16. The level above was 35.33, back adjusted to 34.82. That makes sense, that's the low of the spike base as I just outlined. But why is my level on the chart behind drawn at 34.77? If anyone puzzled over that, then you are very observant, and I'm now going to explain why. We're going to cover a lot of things tonight, by the way, not just Bund, for those that are panicking that fuck me, he's going to go on about Bund all night again. So the answer as to why that level is drawn at 77 is because I've already come down on the 5-minute before the live day started, and I've mapped out the last low pre-break where I expected the reaction from. Now in session 2, you may recall I said that the level I want to trade at must be naked, which means it must be untested on my trigger time frame. So let's go back to the trigger time frame, because this is the hourly and my trigger time frame is the 5-minute for Bund. So we'll scroll back and we'll look at the structure around that 82s, which I'm going to zoom in on here. And again, you can apply this to any single market. Don't get hung up on the fact that it's Bund and you don't want to trade the Bund. You don't want to pay £2.40 for data to TradingView. Forget all of that. You can apply this to anything. So look at that level at 82s. It's the spike base low on the hourly. This is what the structure looks like on the 5-minute. When the market initially broke down through 82s here, it popped back and it retested it. Now, based on what I've said in previous sessions, what do we do when we have that situation? We refine the level to the nearest naked price point. That is going to be the low of this spike here. And what price is the low of that spike? It is 34.77. This is the last point that no subsequent candle has retested, so that is the naked price point at 77s. Now, the first thing you might think is, why not the low of the spike above? Why not up here, this spike candle here at 91s? That's another spike, and it's even more prominent too. The reason the order wouldn't go there is because it's considerably beyond the 60-minute level. The 60-minute level, remember, I've got there at 82s. 9 ticks is overkill in Bund. To put that into perspective right now, I believe the 20-period ATR in Bund is about 66, so 9 ticks is almost 14% of ATR past the level. So coming back to the 77s, how would this be traded? Usually I use stops above the thrust candle, which I've explained before. So if you were to come in and offer 77s, you might look at this thrust candle and think, right, so I can put my stop a tick beyond that. But have a look at the high of that candle, and it's 34.80. So if you put a stop at 34.81, you are stopping out 1 tick in front of where the level is on the hourly at 34.82. You obviously can't do that. So in a situation like this, when I'm trading the low of a spike, I simply put my stop 1 tick above the high. The high is 84s, you'd put a stop at 85s. So the trade there would be essentially to sell 77s, stop at 85s, which is an 8-tick stop. Now, because we didn't get up there on the live day, unfortunately I didn't cover this in detail, and I actually realised when I was watching the recording that I simplified the process a lot for you during that day by just simply saying, look, the actual level at 82 isn't naked, I won't put an offer in there, and I won't hit it like I normally do, and instead we'll just watch it if it gets up there. What I meant was, which I didn't really clearly explain, is go back, look at this price action in a lot of detail and get ready for a reaction from it. But it didn't get up there, so we never covered it. But there was a reason I simplified that process rather than explaining how it could be refined down to 77s and putting the order in, because as 77s is lower than the level, it's nearer to the breakout highs. Remember, the breakout highs here are going to be the FTA. So if you look at 66s on the hourly, that's the FTA right there, and it's not far away. So if you're shorting nearer to that level, then you have to be very careful because it's lowering the amount that you're playing for. And what's more, many times the market can often come up into an extreme high of the range like this, have a sell-off, and then move higher. And that's exactly what it does. And when that happens, the fake out high is the one that I'll key off for a target. So that target would then move up there to that candle high at 68s. So you can see it's just getting closer to where you'd get in. So until I can really see where that comes in, it's too early to kind of frame the trade categorically and say that there'll be a decent enough R to actually merit taking. So if we look at the target and see how that changes as price develops, you see it would start out at 66, it would move up to 68 based on this movement that we had up there, which faked out the high, and then the aggressive sell-off, leaving a really clear swing high up there before NFP. Now that's fine. If you short 77 and you play for 68, that's a 9-tick target. You got an 8-tick stop, and it hits very quickly. It comes up into the 77s, and you can see it straight back down at the 68s quickly. But I really wanted to explain why you might sometimes want to watch the price action before you put the order in, because these things change last minute, specifically targets. So again, if we come down to the 5-minute, you can have a look what happens there. On the NFP, it spikes lower, runs up, tags the 77s, and then immediately pulls back to the 68s. It's a little like the order that I've got in cable. We'll talk more about that in a minute. Here, I've defined the exact point to get in, but it doesn't mean I'll put the orders in, because if it makes an FTA just ahead of it and it reduces the R to an unacceptable amount, then the order's just going to be cancelled. In cable, I've gone about things a little differently. I've put the order in, and then I've told you it might need to be cancelled depending on the price action leading into it. Again, if we start making FTAs just ahead of where we're getting in on cable, then the order's probably going to end up being cancelled because the risk reward is going to diminish dramatically. Now, I told you at the beginning of this session I only had one trade this week, and this wasn't it. So in full transparency to you all, I didn't take this. I had to go over and help my mum. I was with her over NFP. It was unavoidable. She had a fall earlier in the week and needed me, and although I kept the order in cable over the number, there was no way I was going to put this in because I wouldn't have been able to actively manage it. I wasn't concerned about cable because it was very far away from the level coming into NFP, but this wasn't at all. Now actually on that point, someone messaged me and said that they'd isolated this level, but they pulled it because of NFP. And they said, was that the right thing to do? Because, on NFP there can be a big spike and you could have some bad slippage. My answer was, they were kind of right and wrong. It wasn't a wrong idea to pull it because we were trading relatively close to it, and you don't want the possibility of being slipped when liquidity goes out of the market as the number crosses the wire. But when the number came out, Bund initially dropped fairly sharply before reversing, and after the first couple of minutes is out the way, I will usually put orders back into the market as I can see volume come back into the market. So in this situation, it really should have gone in. It didn't. It is what it is. At any rate, it would have only been a 1.13R, but it would have been a good play. And on the subject of this type of trade, you're not going to set the world alight with R's of just over 1, but the accuracy and the high probability of these types of trades means you can just keep picking off other traders who get caught, and you do balance a relatively low payoff with R's of between 1 and 2 with a very high strike rate. Now, I know there's somebody in here looking at this hourly chart and thinking, okay Tom, look, a winning trade of 9 ticks is good, but fuck me, man, it was the higher day. Look how far it went. And that's fine. I'm not trying to capture all of this movement in either this play or when we very first spoke about Bund and the weekly level, and I was talking about a very short-term trade here, and look where it's fucking gone. Sometimes I will be looking for a huge move, but remember, on days when I have no bias, then it is simply level to level, and that's how I do things. If you want to try and use these levels to get into longer term trades and hold, then that's what you've got to look into doing and see how that works for you. Let's move on. A sigh of relief is breaking out from everyone. I can feel it. One of the other things I did on Thursday was I put a buy order into the pound dollar, and it is still in the market right now. It hasn't filled, but it remains in with the same entry, same stop, same target, exactly as you can see here. We're buying the last high pre-break. This is a weekly level. If you come onto the weekly, you'll see it's a weekly swing point. And if we come back down to the hourly, you'll see that my stop has gone underneath the thrust that closed through the level, and so far the FTA is the lowest low to the left. The reason I said things like this can change and even orders can end up getting cancelled is essentially because if we come down and fake out this low, turn somewhere around here and then start to find considerable support, then that would be the FTA and the trade might not work from a risk reward perspective. So again, what we really want to see here is some acceleration down into the level for me to just stand in front of it. So that is cable. There are some questions that are occurring about this pretty bearish looking candle. You've got a bearish engulfing that takes out the prior day's high, leaves a long rejection wick and closes below the prior day's low, and there'll be some suggestion based on material that people have seen in me before that it might not be the best to fade that. My response to that is look where we're fading it from. If I was using that as a bearish bias, I'd be looking for it to take stops beneath this low and attack this area. And that's exactly where I'm trying to pick it up for a short-term reversal. So I have no problems standing in front of this if it comes down here. So that is cable. Now let's turn our attention to gold. Now, we discussed, again on the Thursday live day, how I thought it was possible that we could run on this high. So if we just put it on the daily, for context, it was the extreme high of the range up there. Let's come back to the hourly. I also explained that there were two levels that were really key below market, and those levels were this level here, which I will put in as an hourly level because it is an hourly level. This was the last minor rejection before price broke up and out and started to move very close to the liquidity pool up here. That was the first level, and the second level was this one, which I'm sure you know by now is the head of the daily spike, or hammer if you like. You're noticing a recurring pattern with these spike candles, right? Got your notepad out, jotting it down? We look for reactions from them. So my plan, as I went over it on the live day, was to see if we closed the day around this point on the chart. I essentially wanted to see that we'd closed up and out of this last hourly level. And if we did close up there without having retested it in the day, I said that what I would be doing is I would be coming down and bidding this level, so just putting an order in to buy this level. Many times, as I said in the session, when we stop just below a key resistance, we will often have a very shallow pullback and then just run the highs of the range. And if you bid too low or too far back, you're probably going to miss it. So seeing it up here, this was the first level to the downside, but I said it was very important to me that it closed above there on the daily before I was personally interested in putting the order in. Note the price action on the day of NFP. So actually coming into NFP, it's really trading around that same point as it was in the live day when I was talking about a shallow pullback and then a potential run on the highs. And that's exactly what happens. There's a very shallow pullback here. We return again to this big hourly level before running most of the highs of the range, including the inside week high. If you note where the inside week high comes in, I'm going to put this in red. Have a look where that comes in on the chart and you'll see we literally just took that out. This is cash gold, by the way, not the futures. If you take one side of an inside week out, which we did in gold, and we get back above the low of the inside week, you can start thinking about it taking out the other side of this range. In this case, the inside week high. It does exactly that here, but again note that it doesn't take out the extreme high of the range. Someone tweeted to me and showed me their gold trade with the entry, stop and target on. And I'm not going to name the person, they probably know who they are though, but let me put on the chart what their entry, stop and target was. They had an entry of 2057.7, okay, which again, I'm sure this is probably based on this high that we spoke about. Maybe they've accounted for spread or their feed slightly different, but that was where their entry was. They had a stop, just put the stop in, of 2497.9. I think they were trading this on a different time frame, a 15-minute, but based on the hourly structure, that's fine because you're protected by the head of the hammer. So if it does return to the head of that hammer or spike candle, you've got a stop below that. So that's a decent stop in my opinion. And then they had a target, I'm going to put this in yellow. $2528.0. And obviously they've been filled here, and I think when I got the screenshot it was somewhere around here. And of course the very first thing I quipped to them was, that's why you never fucking move to break even. Because if you have a look what happened on NFP, it popped straight back to where they got in and then immediately went straight to their target. Now I don't know what happened to this trader. The reason I'm relating this to you is the break-even phenomenon, which always makes me chuckle. It was one of the very first things I noticed when I started analysing my trades back in the day, was that there is a strong tendency for the market to come back and test key areas for a second time. So if you take a position at a good level and you get a reaction and then you get your stop up to entry, you make yourself very vulnerable to that phenomenon of the second test. And many times in my early career I did this and I would puke the exact turn. In actual fact, this is how I came up with the return to spike based strategy. It was based on this exact mistake. So what I used to do, and I'll give you an example from a daily chart. Let's say that you've seen a spike like that off a very good location. As it breaks the head of the spike, I would get long. This is back in the day, this is not now. It surges into profit and I would move to break even. It would come back, it would take me out for break even, then it would go straight to target. And I saw that time and time and time again, but I kept moving to break even because it helped psychologically. You feel like you've got the free trade. You can relax now. And I was noticing this phenomenon as far back as 2008, that I would just keep puking the turn and then seeing that the original trade idea was right. So I turned it on its head, and what I started doing is I started taking profit on the first explosive move, and then I would rebid the return to the spike, and it's just worked so exceptionally well over the years. And that example is really the best one I can give you of why it's so important to analyze your performance, because you can come up with ways to turn a mistake that is costing you money into real edge. I even remember when I investigated this and really decided that I was finally going to solve this problem once and for all, which was when I was on the trading desk at Futex, and I had a position in cable. I'd bought a really, really good level, and it had gone parabolic. I was nicely on side. I moved to break even, and it came all the way back, stopped me out for break even, and then it just went fucking vertical straight to target. So I'm sitting there and I'm like, oh, I've done my fucking arse, man. It's taken me out. It's found my stop, and it's done exactly what I knew it would do. It's gone straight to the target I initially had. And the head honcho at the prop firm sauntered over and stood behind me, and I'm still ranting, and he's like, what did you do, Tom? And I was like, well, the market's come back, it's taken me out, it's gone to my target, it's just really frustrating. And he's like, right, but why did you have your stop there? And I said, well, because I moved to break even, so I had a free trade, couldn't lose money on it. And he's like, you did fucking what? And I was like, I moved to break even. He went mental. He went as red as a fucking tomato and started screaming, and was just saying, what kind of cunt just moves to break even for the sake of being at break even? You place your stops based on market structure. What the fuck are you doing? I didn't dare tell him that I'd been doing that for fucking ages before that as well, and had noticed the mistake several times and done nothing about it. So at that point I was like, okay, right, I really need to do something about this. It's one of those things that I've spoken about in trading before, where you're not going to get the same result every single time. So sometimes you're going to move to break even and you'll think, great, that was actually the right thing to do because it's come all the way back and it's gone a lot lower. So thankfully I had a stop at break even. The thing is, you have to look at it over a decent sample size of trades to really understand what's going on. And that's what I wasn't doing. I was just getting too involved in recency bias, getting angry when I puked the turn on a break even, but then being really thankful when break even saved me taking a loser. So you have to look at things over a larger data set to really see what is going on. But that, again, is the best example I can give you of analysing your performance, seeing something that's a mistake, seeing something that's costing you money, and then coming up with a way to turn that mistake into edge. And again, now when I see, for example, let's say a hammer at a very decent location on the chart, I'm looking for the long, but I'm looking for that explosive move away, getting out of the FTA and then rebidding the hammer head. I'm using hammer and spike interchangeably, but hopefully you guys know that by now. The other day in one of our discussions, I spoke about how I found that most people over the years can't beat passive management when they trade. So that's to say, if they've got an entry, a stop and a target ahead of time, and they track the black and white outcome of that. So do we hit target before stop? It's either a simple yes or no. And they compare that to their actual trade management. If they do use trade management, they usually can't beat being passive. In this specific case of the guy that tweeted to me with his gold trade, it certainly proves that passive management would have worked a treat. If he had done nothing, he would have seen that all the way to target. You have to remember, making trading decisions is hard. You have to work out not just where the market is going, but whether it's going to X, which is your target, before Y, which is your stop. And making that decision is a skill set which many people out there that are actively trading still haven't refined. And now think about compounding that lack of refinement with trade management. Every time you manage a trade, it's another trading decision. If you move your stop up in a situation like this when you're long, you are once again saying, I believe it's going to X before it moves to my new stop at Y. It's the same as what you did at trade outset. If you weren't in the trade, it's like taking a new one. So managing a trade for many new traders is forcing them to keep doing the thing that they aren't very good at, which is making another decision of where it's going before it goes somewhere else. And it's much harder as well because they're now in the market's moving, risk is on the line, emotions are in full swing. And I think that many people take this too simplistically and they simply say things like, I don't want to take a loser now, so I'm going to move to break even, without even regarding the market context, which they so carefully analysed when they got in the trade. You hear people saying things like, well, I'm on side and if I'm right, it shouldn't come back now. Why the fuck shouldn't it come back? If a level's great and it starts to react to it and you're on side, are you telling me you're completely wrong if it comes back for one more test of it? Or is that P&L talking? I don't want to take a loser, so if it comes back, I'm getting out, so I haven't got to suffer that pain of being on side and then taking a loss. So I always tell traders, track the outcome of no management versus active management, and start by even just analysing this over your last 30 trades. See if there is a disparity, and if there is a disparity, see how big it is, see what comes out ahead. The second point I wanted to make here was evolving R, which is a term that you've probably heard me discuss before. If you haven't, what I essentially mean is that risk reward is not a static concept. When you take the trade and you put in your stop and your target initially, you've obviously got a risk reward ratio, but as soon as you get filled on that trade and it starts to move in your favor, if you don't touch the stop, the risk reward ratio is evolving from the point where the market is currently trading to the point where you have your stop and the point where you have your target. So if you've taken a trade like this and you're aiming for the extreme high up here, which is where I personally thought we'd probably make a run on, and you see this candle here, what the fuck do you do? Now, because I wasn't in this trade, I can't give you specific metrics, but let's play it out with a theoretical long position. Let's say that you take the trade here off the level that we spoke about. Let's say you even put your stop underneath this thrust candle here that closed through the highs. You're well protected by the hammer high on the daily, and you use a target up there. It would usually go a tick beyond it, but just let's say that you use that high, and I'll take the other guy's trade levels off the screen. That would give you an approximate 1.77 R. Now, because I trail stops on the hourly, and usually I only trail stops on closes through structure, I wouldn't have done anything if I'd been filled on that. The next day we would spike lower and I'd see it come all the way back to entry, and then I would see it move aggressively towards target but not hit it. At that point, I could certainly move the stop up from where it was to underneath this candle here, which is the low of the candle that's retested this area for the second time. But if you were to use the risk reward tool in this way and look at it from the close of that candle, you can see there's really only about 0.6 R in your evolving risk reward. You have to combine that with the actual fact that you have traded through an inside week high, have failed there, and failed at the previous day's high. This is a bullish candle. If you look at specifically just the candle, it's a bullish engulfing, but if you look at the context of where it's been, it has trapped a lot of traders. So now you're looking at a potential trap, and you're seeing that if you keep your stop all the way back here, your risk reward is significantly diminished. And you've got to ask yourself, how confident are you that this is now going to get to target? Because the amount that you're up on the trade is as good as secured. All you've got to do is click the mouse to bank it. I remember someone saying to me in prop, think of it this way, if you're in this trade and someone leans over your shoulder and closes you out of the trade right there and says, oh, I'm really sorry mate, my mistake, closed you out by accident, just get back in again. Would you take that trade entering up here with a stop down there and a target up there for a 0.6 R when the price action looks like this? I'm absolutely sure you'd say no fucking chance. So if you wouldn't get back in the trade, why would you hold it? So the only time that I will hold trades if the R has significantly diminished in terms of where my target is and where my current stop is if I'm absolutely convinced that it's going to hit my target. And in a situation like this, maybe your conviction of your perceived probability merits holding, even though the R ratio is going down faster than Harvey Weinstein's trousers at a casting call. But you're the only one that can make that decision. These are the decisions that you have to make on the fly when you're executing. How much are you up versus how much you're aiming for? What's the perceived probability of it reaching the target before it pulls back and hits your stop? Since ours constantly evolving, you'll have a new dynamic in play than it was at the trade outset, and you've got to make a decision based on that. But again, to cover why I didn't trade it, it's certainly an acceptable trade to take under normal circumstances. It breaks the level. There's a rounded retest. By rounded retest, I mean after the breakout candle, it doesn't come back in the next candle. There's space between the break and the eventual retest. Even the acceleration into the level is nice. That's certainly not a drift. But my caveat here was that I wanted to see the daily close above that level without it pulling back intraday. And I didn't become a buyer here because I have a rule which probably everybody knows, unless there's very new traders to my style in here, that I don't buy a level that's been tested before. So I don't buy prior support. It would have to be naked there for me to have traded that. I could have potentially bought this because this level was naked, but by that time it's faked out the inside weak high and all the range highs and is coming down aggressively. You don't want that. I certainly didn't want that for a swing trade. Having said that, look at the reaction. It doesn't touch it perfectly. If you come down to a 5 minute, you can see how the market turns just ahead of it. These levels, whether you're swing trading or short-term trading, can be super effective. I made the joke about having more fucking lines than James Belushi's coffee table, and the fact that if you start drawing SR, you can draw it everywhere. There's a low here, and there's a few lows back there, right there's a level, and there's a low down here, that's a level, and here's a support low back here, and here's a flip from resistance support. There's fucking levels all over that chart. But if you go back and look at the live day, how many levels did you see me have on that chart? I thought, it's going up here, I've got 2 drawn in. I had the inside weak low drawn in as well, but I'm not prepared to be a buyer there because I said I'd be using that as a frame of reference. If we get a considerable close beneath it, I might even have to look for a short. But the only 2 levels I was interested in is these 2. So there's not a mountain of SR levels on the chart. You've got 2 absolutely key levels. So the premise is understand where the good levels are and then key off them, whether it's to the FTA or whether you're trying to run things further. But you can get exceptionally good entries with simply using this premise of drawing SR based on last high pre-break, last low pre-breaks of significant ranges, as long as you isolate the LHPB or LLPB in the right way, and spike highs, spike lows. So if you've got a rejection candle like a hammer, it's the high of the hammer that's important. If you've got a rejection candle like a shooting star, it's the low of the shooting star that's important. So just looking at the questions, the level always has to be naked on my trigger time frame. So to understand what a naked level is, if you see this level here, this was naked. When the market broke out of it, it hasn't retested on this time frame. Now it's possible that you can check every single time frame and you might find it's not naked on one of them. Someone will be going, I looked on a 3 minute chart and no, it's not naked. It doesn't matter. To me, it matters about the trigger time frame. As long as it's naked on that time frame, I'd be prepared to trade it. So the question that you're asking, Sunny, how to define my trigger time frame, is whatever time frame that you pull the trigger on. So in Bund, for example, I do analysis on the weekly, analysis on the daily. I start looking at market structure on the hourly and plotting more levels and see how price is developing during the day. But the 5 minute is the time frame that I enter trades on, that I place my stop based on, and that I manage trades based on. So as long as the level is in Bund naked on the 5 minute, I can take the trade. On an example like this gold, it doesn't have to be naked on the 5 minute because I never drop below an hourly chart when I'm swing trading, and this is a market I swing trade. So as long as it's naked on the hourly, it's good to go for me. So finally, let's move on to the dollar Canadian. This was my one trade of the week, and it fucking filled at 5:49 on a Friday evening. One of the highest probability trades you can take is you can put your ATR indicator on the chart, so you know where ATR high and low is coming in. Wait for the market to surpass it, and then if it surpasses it to the upside, look for significant prior lows to sell for a short-term trade back to your FTA. If, on the other hand, it surpasses ATR to the downside, look for a significant area of old highs to buy for a short-term trade back to the FTA. This is an absolute bread and butter trade for me. So if we just bang ATR on and we use market replay, we can just go back and see where ATR was on the day. So that is what it looked like on the day. You can see that we were surpassing it. Now, before we look at where we are in relation to ATR, let's come down and look at the weekly chart. So what's the first thing you see on the weekly chart? It is, or it should be, that low right there. It's a support low, the market's broken it, it's coming back up into it from below. That's as far as the analysis needs to go to cover this trade on the weekly time frame. Now we move to the daily. You've now got a different price point. The last low pre-break on the daily looks like it's coming in here. Now you've got a weekly last low pre-break and you've got a daily last low pre-break. Now they're pretty close to one another, but they are at different prices. Now let's look at the hourly. The lowest one, which is not the one I traded, had a reaction. Straight away it hit that, immediately moved back. So there was a reaction off the last low pre-break on the daily. I didn't trade that because I felt that if you're using this area as an FTA, it's far too small. There's literally nothing to play for. I mean, the irony is with some of these levels is that the reactions are so precise that you can get away with tight stops that would make most people wince. And you might look at this thrust candle and think, my God, you could have had a stop there above that. Tom uses thrust candles. That would have worked. That would have even made a small trade like that acceptable. I would never have put a fucking stop there. You know, I like tight stops. I ain't going that fucking tight. Especially with these lows on the chart here. You're literally stopping out into these swing lows on the hourly. So forget this level. I'm just highlighting it as the fact that there was a reaction. But if you have a look up at the weekly level, which is the highest time frame level that we trade, and you have a look at how price crossed it, what you will find is that there is a spike. And it's naked. This low hasn't been retested after we get a close through it. That becomes my last low pre-break. See where ATR was on the day and look how far that level is beyond it. So you have the market being well above ATR, and also you have the time of day. It's coming close to the close and the close of week. So you've got the dynamic of traders being likely to close positions as we come into those last few hours before that close of week. So I went and offered it at the low of the spike with a stop above the high of the spike and a target of here. This should all be fairly straightforward. Let's get this level off the chart. So the trade was set up like that, and then we'll take market replay off, and that's what happened. It filled, it traded down super quickly. Now some of you might think when you're watching this, but Tom, you're getting out here, would you not have moved your target there? No, because that wasn't really a proper swing point. So once more, we've got the level being past ATR, we've got a weekly level, we've got the spike base low, we've got the time of day impacting on the decision, and we've got the price movement that we want to see. We've got a sharp price movement in. There is no drift into this. Everything is coming together. And I've told you guys before, I have a high strike rate when I trade for one reason and one reason only, which is because I'm fucking picky and I wait for everything to come together like this. If you break it down in terms of those three things that I said every trader should know in their plan, what you want to see? You want to see acceleration in price. Where you want to see it at the weekly level refined to the spike base and past ATR. When you want to see it. On a Friday evening, 3 hours before the close of play, with the increased likelihood of mean reversion from traders closing their positions into the end of week. What you want to see, where you want to see it, when you want to see it. Now, by the way, and this is quite an important caveat to add here, this time of day isn't essential to all my trades. I'm not saying that every time you fade a level past ATR it needs to be into the close. No, that's just a time window that is effective for mean reversion. But if you have a market trading past ATR into a good level, the chance of a reaction, as long as you're not trying to overstay your welcome and you're playing from one level to the next, essentially our FTA, is very, very good. Almost every single day something is happening somewhere that gives you a setup, and that's why I said if you do get to the end of the week like me and you've only had one trade, you better have a good fucking excuse, because there is a lot of opportunities out there. Now, like I said, this week it's been very unfortunate for me. I have been worried, I've been stressed about my mum and her health, and hopefully things get better. So it's a winning week. Let's get on it this week. Cheers, guys.